Hello, everybody. This is Samera here, and today's webinar we've got David Hossein on the call. Say hi, David, to everybody.
Hello.
Hi, and David's our head of accountancy and tax services. And today he's going to be talking about a question that we get all the time: Can I have a company car and what to consider? So take it away, David.
Hi, thanks, Aaron. So firstly, thanks for joining us today. I'm going to explore an area that I get asked about a lot, mainly around how it's possible to get tax relief by using a car in your business. Most dentists will either be a sole trader or a limited company, and this short webinar today will look at both of those situations and the option of using a car and how to get tax relief. If we can look at the first slide, please, Aaron. Okay. So if you are a sole trader, whether that's an associate or a principal, legally, there's no difference between yourself personally and your business. So for sole traders, a company car doesn't actually exist as such. You will always own the vehicle personally. However, as a sole trader, there are two methods that you can use to claim tax relief on business journeys. It's important to explore what HMRC will classify as a business journey. It unfortunately does not include from your place of residence to your main place of work. However, if you do work within multiple sites, travel between those two locations is included. Travel to courses and anything that is related to your trade, whether that's buying equipment or buying stock, all of that does in fact get classed as business mileage, if you like. So the first method for sole traders is the mileage method. Within this method, all you're required to do is record the miles that you travel in a year, and you are able to claim a deduction of 45 pence per mile for the first 10,000 miles and 25 pence per mile thereafter. It's a slightly generous allowance, and the reason for that is it includes all the costs of buying, running, and repairing the car, as the slide mentions there. The second method is the actual cost method, and for this method, you actually use the actual cost of the car. That includes the purchase cost of the car, all the running expenses, etc. To calculate this, what you are required to do is record all of your mileage throughout the year and come up with a percentage that is the business proportion. The example here uses 20%, and then you will be able to claim 20% of the running costs and the purchase cost of the car. And as the last point says there, if you are using the actual cost method, you can also claim capital allowances on the business portion of the car. So both of those are options to consider. If you are a limited company, however, a limited company is a separate legal entity. As a director, you are employed by the company. Therefore, the company can provide you with a car as part of your remuneration package and obtain relief on the cost of the car and its running expenses. HMRC don't like company cars. They do have a prohibitive additional tax called a benefit in kind tax that will be calculated, and in most cases it is likely that the additional tax will outweigh the tax relief available. However, the exception to the rule is the emissions or electric cars, so the low emission or electric cars, which are becoming increasingly high end. The likes of the BMW i8 and Tesla cars are good examples of those. I'll talk to you a little bit how this can work if we look at the next slide. So under a limited company, if the company buys a car to provide to yourself as a director, if it is a new and unused low CO2 emission or electric car, you are able to claim 100% of the value of the car as a first year allowance, which basically reduces your tax by the value so it reduces your taxable profits by the value of the car. If it's a car that is not defined as a low emission car, so above 75 grams per kilometre, but less than 130, you can still get tax relief on the value of the car. However, it's 18% reducing balance per year. Second-hand cars beneath 130 grams per kilometre, again going the 18% main rate pool. If it's a second-hand or new car where the emissions are over 130 grams per kilometre, that's deemed to be in the special rate pool, and 8% of the car value is claimed as a capital allowance. Now let's look at an example to understand what that means. So the worked example here looks at a company that makes profits of £100,000 a year. Corporation tax is down from 20% to 19%, so this company will pay tax £19,000. If the company were to buy, say, a Tesla, an electric car at £40,000, it can claim 100% of the cost of the car in the first year as a capital allowance to reduce the taxable profits. Therefore, the revised profits come down to £60,000, and the reduced corporation tax bill is now £11,400, saving tax of £7,600, i.e. 19% of the value of the car. This applies whether you buy the car outright, or additionally, if you buy the car via hire purchase. And from a cash flow point of view, it is possible to enter into a hire purchase agreement before your company's year end, make a minimum amount of monthly payments, but still get the full tax saving in the financial year that you actually buy the car. So from a cash flow point of view, this can really help families with overheads. So those are kind of the two.
Can I?
Yeah, sure, go for it.
Perceptive, David. In terms of, this is purely a company, though. It's not an individual, correct?
Yeah, the second example we've looked at is just for a limited company.
Okay, so if I was an associate and I was trading as a normal associate sole trader, this wouldn't apply to me, correct? Isn't it?
It wouldn't apply. You would fall under the first example of being a sole trader. However, if you were my client, I would first ask you the question: well, would you like to become a limited company and explore whether that's the right thing for your circumstances?
Sure.
Just because you might be a sole trader today, it doesn't mean you can't become one tomorrow. We do need to look at the NHS superannuation to make sure it's right for you, but that's a conversation that you would have with your accountant.
Okay. All right.
So in summary, the things to consider: should I be claiming business mileage? You certainly should if you aren't at the current moment. If you're a sole trader, let's think about claiming a percentage of the capital cost of the car and the running costs. Again, that only applies to the business element percentage of your car usage. And lastly, if you do have a limited company, think about a company car, but do beware of benefit in kind tax. Low emission electric cars are best.
Okay. Brilliant. Thank you very much. David is available to talk, or if you've got questions or you're thinking about buying a car or you need any help with your taxes, David and his team are available to help. I hope you found that very useful on this very short webinar today. Any further points to add, David, or should we say bye-bye?
Yeah, no, as you've mentioned, get in touch if you'd like us to answer any questions around this topic or any other.
Okay, thanks a lot. Thank you. Bye-bye.
Bye-bye. Bye.